There's a sound to money when it's free. It's wild. Untamed. Electric. That was Bitcoin in its youth, a spark ignited by a nameless coder, born in the ashes of the 2008 collapse. But in 2025, that spark now glows behind glass, sealed within boardrooms, ETFs, and asset management giants. Welcome to FluxFolio Finance. Today, we ask the question no one else will: has Wall Street saved Bitcoin, or swallowed it whole? To answer that, let's start with BlackRock. As of May 2025, BlackRock's spot Bitcoin ETF, the iShares Bitcoin Trust, IBIT, holds over 353,000 BTC, worth roughly $36 billion. That makes BlackRock the second largest institutional holder of Bitcoin, behind only Grayscale. Since launch in January 2024, BlackRock's ETF has seen steady inflows, totaling $15.2 billion by Q2 2025. Inflows spiked in April following a drop in Treasury yields, and again in May after Trump's Strategic Bitcoin Reserve Act signaled growing government acceptance. At the same time, however, April also saw $4.3 billion in outflows from Bitcoin ETFs across the board, led by profit-taking and rebalancing. Even as BTC flirts with the $100,000 level, there's an eerie mechanical rhythm behind the price. Buy. Sell. Rebalance. Pause. Repeat. Clearly, this isn't a community-led rally. This is algorithmic choreography. To put that in context, we must consider BlackRock's long-standing relationship with Bitcoin. Its embrace of the asset isn't new, but its level of control is. When Larry Fink called Bitcoin a global digital asset in mid-2023, it marked a seismic shift. Since then, institutions like Fidelity, ARK, Franklin Templeton, and Wisdom Tree have followed. The result? Over $72 billion is now held in US-based Bitcoin ETFs. Of that, nearly $29 billion sits with BlackRock and Fidelity alone. In this way, the Bitcoin revolution was never supposed to wear cufflinks. And yet, here we are, 401ks buying Bitcoin. IRAs holding cold storage keys. BlackRock, once synonymous with central bank liquidity support, now underwriting the next monetary experiment. This raises a deeper question: who controls the narrative when the rebels retire? At first glance, all of this seems bullish. Bitcoin in retirement accounts. Spot ETFs making it easy to invest. But scratch deeper, and it's a system of pipes. Not belief. Capital moves in, not because people believe in decentralization, but because models say allocate 3% to crypto. In other words, this is passive inflow masquerading as conviction. But if risk metrics change? Those same models can flip, and $500 billion could become $50 billion in days. That's not hyperbole. That's what happened to mortgage-backed securities in 2008. Everyone was in until they weren't. Now, let's address the $500 billion number you keep hearing. Some analysts project that if U.S. pension funds allocate just 1% to Bitcoin through BlackRock or other ETFs, it would unlock $500 billion in new inflows over the next 5 years. That's more than the entire current market cap of Bitcoin held by institutional investors. However, here's the catch: most of that capital isn't buying spot BTC. It's ETF exposure, meaning synthetic Bitcoin, sometimes fractional, often borrowed. The actual coins? Custodied by a handful of firms. Coinbase. Fidelity. BitGo. So this isn't Bitcoin on a USB drive. This is Bitcoin with a cusp number. To add another layer, consider the strategic reserve twist. Let's rewind to March 2025. That's when President Trump signed the Strategic Bitcoin Reserve Act, legalizing the use of BTC as part of U.S. strategic reserves. The government won't say how much it's bought, but insiders suggest the Treasury now holds between 25,000 and 40,000 BTC, stored in cold storage managed by public-private consortia led by Fidelity and Anchorage Digital. Meanwhile, Tether, the largest stablecoin by volume, holds over $150 billion in U.S. Treasuries. Circle, issuer of USDC, holds another $60 billion. Together, these stablecoins are de facto buyers of U.S. debt, while also operating as liquidity bridges between fiat and Bitcoin. The irony? The very asset created to bypass central banks is now used to backstop their monetary experiments. But let's go even darker. What happens when Bitcoin becomes the collateral behind the next financial system, but also the first asset dump during a crisis? We already got a glimpse in April, when Treasury yields jumped 23 basis points in a single day. ETF flows reversed. A $200 million net inflow turned into a $700 million outflow within 72 hours. That's how quickly sentiment can shift. And ETFs are forced to sell if redemptions accelerate. In a liquidity crunch, BlackRock doesn't ask permission. It sells. And when BlackRock sells, the market moves. This is the controlled collapse scenario. Bitcoin becomes an asset not of conviction, but of convenience. Easy to acquire. Easier to offload. The question is, will you still be holding when the system pivots? Let's now step back and examine the philosophy behind it all. Bitcoin was designed to be uncensorable. Unstoppable. Self-sovereign. But ETFs are regulated. They are surveilled. They can be halted. And their custodians can be compelled. This is no longer Bitcoin the protest. This is Bitcoin the policy tool. When BlackRock controls the rails, and the Fed regulates the tax treatment, and the Treasury holds it as a reserve, have we not simply created a new Bretton Woods? But this time, instead of gold in Fort Knox, it's Bitcoin in cold storage, tokenized, collateralized, and absorbed? On a global scale, the picture sharpens. China banned Bitcoin ETFs in 2024. Europe has MiCA, which limits spot crypto ETFs under certain leverage thresholds. But the US? It leads the charge. The result? A bifurcated crypto future. On one side, Bitcoin is asset. Held by BlackRock. Traded via Fidelity. Taxed and securitized. On the other, Bitcoin is network. Used by El Salvador. Mined in Paraguay. Transacted via Lightning in Nigeria. This is the fork no one talks about. Not Bitcoin Cash. Not Bitcoin SV. But Bitcoin Wall Street versus Bitcoin Underground. Adding to the risk, let's talk leverage. As of May 2025, over $1.1 trillion in basis trades sit on institutional balance sheets. These trades involve long Bitcoin spot positions paired with short ETF or futures contracts. It's a way to profit off arbitrage, but it creates massive exposure to spread risk. If spreads widen, if ETFs decouple from NAV, if liquidity dries, these trades unwind violently. We've seen it before. In March 2020. In September 2022. And now, the positions are bigger than ever. So what's the takeaway? Bitcoin could go to $1 million. It really could. Especially if BlackRock, Fidelity, pension funds, and governments keep buying. But will it be your Bitcoin? Or theirs? Will you own the keys? Or just a ticker? And if a liquidity crisis hits, will you sell into the fire? Or will you lend into it? Because that's the new game. It's no longer about holding forever. It's about surviving the next systemic shock, and buying the dip when institutions are dumping. So here's your FluxFolio playbook. If you hold Bitcoin, hold your keys. Not your brokerage account. Watch ETF flows weekly. When BlackRock slows inflows, prepare for volatility. Use your BTC as collateral, only with protocols that support non-custodial lending. Beware of leverage. Especially in ETF-based trades. Know that if Bitcoin becomes a reserve asset, governments will fight to control it. Don't be the exit liquidity. Bitcoin is no longer just code. It is currency. Collateral. Weapon. Mirror. The institutions have arrived. The gates are closed. And the games have begun. Thanks for watching FluxFolio Finance. Like, subscribe, and tell us, is this Bitcoin's rise, or its end? Because sometimes, the revolution doesn't get crushed. It gets funded. And bought. And quietly. Rewritten.